Canada is often portrayed as a symbol of financial stability, fiscal discipline, and a safe banking system. Yet behind that calm image lies a reality that is rarely stated directly. Canada's total debt has grown to a level that would make even developed economies pause. This is not only government debt, but also household debt, corporate debt, and financial obligations deeply tied to real estate. When interest rates were kept near zero for years, credit became the fuel of growth. Housing prices surged, assets expanded on paper, and a sense of wealth spread across society. But when inflation emerged, the cycle reversed. The Bank of Canada was forced to tighten policy, interest rates rose rapidly, liquidity shrank. The Canadian dollar became more volatile, borrowing costs increased, and loans once considered safe revealed their true weight. CDS began to price higher credit risk, housing markets slowed, and confidence became more fragile. The question is no longer whether Canada has debt, but how much pressure this economy can withstand now that the era of cheap money has ended. Signs of stress never appear overnight. They emerge quietly, hidden in indicators most people rarely watch. Household debt-to-income ratios in Canada remain elevated, reflecting an economy heavily reliant on leverage. As interest rates rise, variable-rate mortgages feel the pain first. Monthly payments increase while real incomes are eroded by inflation. Housing markets, once the engine of growth, begin to cool across major cities. Credit liquidity is no longer abundant, and banks grow more cautious with risk. CDS levels signal rising concern, even if not yet at crisis thresholds. The Canadian dollar fluctuates more sharply with global shocks, reminding investors that Canada is not immune to international financial cycles. These signals are not dramatic, but they matter. History shows that crises rarely begin with a sudden collapse. They start with small cracks that are easy to ignore until it is too late. To understand why these cracks matter, one must understand how debt-driven shocks work. When interest rates are low, debt lubricates the economy. Businesses expand, households buy homes, governments spend freely. But when inflation escapes control, central banks must reverse course. Higher interest rates do more than raise borrowing costs. They drain liquidity from the system. Money becomes expensive, credit tightens, and leverage turns from growth engine into burden. Asset prices come under pressure, especially real estate, where Canadian households hold most of their debt. When housing stops rising, the wealth effect reverses and consumption weakens. Exchange rates react to capital flows, while CDS markets quietly reassess future repayment risk. Economic shocks rarely come from a single trigger. They emerge from the interaction of rates, liquidity, and market psychology. Once this chain reaction begins, reversing it becomes extremely difficult. Global history shows that debt is always a double-edged sword. The Asian financial crisis of 1997, which required IMF intervention, was fueled by short-term capital and foreign currency debt. When currencies collapsed, debt burdens exploded within weeks. Argentina has repeatedly fallen into similar traps, borrowing to maintain short-term stability, then losing market confidence as CDS surged and the peso collapsed. Greece became the emblem of sovereign debt crisis within the Eurozone. As liquidity evaporated and bailouts came with harsh austerity, Turkey and Venezuela illustrate another path: high inflation, weak monetary credibility, collapsing currencies, and severe damage to daily life. These cases differ from Canada in structure, but share one lesson: when confidence in debt management erodes, financial systems react violently. Canada is not exempt from this rule, and history reminds us that stability only lasts as long as debt remains within the economy's capacity to carry it. Canada's uniqueness lies in how deeply debt is woven into everyday life. Household debt is heavily concentrated in real estate, making housing the core of systemic risk. When prices rise, debt appears manageable. But as interest rates increase and transactions slow, repayment pressure becomes visible. Businesses, particularly in construction and services, face higher financing costs alongside weakening demand. Federal and provincial governments confront rising budget stress as borrowing costs climb. Bond market liquidity is no longer cheap, forcing difficult trade-offs between stimulus and fiscal discipline. The Canadian dollar reflects sensitivity to global capital flows, while CDS signals rising but contained risk. Together, these factors create an environment where even a modest external shock could amplify domestic vulnerabilities. When debt binds all sectors together, stress in one area can quickly spread throughout the system. For individuals, debt is no longer an abstract concept. It shows up in mortgage statements, student loans, credit cards, and rising living costs. As interest rates adjust, many households are forced to cut spending simply to remain solvent. Weakening consumption affects not just small businesses, but overall economic growth. Workers face a dual squeeze. Real wages fall while financial costs rise. Real estate, once seen as a safe asset, becomes a source of anxiety when prices stagnate. Defensive behavior spreads, further reducing liquidity in the economy. Indicators like CDS and government bond yields may seem distant, yet their effects are immediate. Savings lose purchasing power, and long-term plans grow uncertain. When debt reaches high levels, even small policy shifts can ripple directly into everyday life. Under mounting debt pressure, the response of the government and the Bank of Canada becomes decisive. They must control inflation to preserve monetary credibility, while fearing that excessive tightening could destabilize the debt structure. Interest rates are adjusted cautiously, paired with assurances of banking system liquidity. Credit support programs are designed more selectively, avoiding perceptions of blanket bailouts. Bond yields reflect expectations of prolonged high rates, while public sector CDS remains manageable but no longer cheap. Governments must balance higher borrowing costs against social pressure over housing and living expenses. These decisions are not merely technical, they are about trust. In a leveraged economy, once markets question policy credibility, reactions can become swift and unforgiving. A closer look at Canada's balance sheet reveals that the issue is not only the size of debt, but the speed at which it accumulated. Large stimulus programs expanded government bond issuance, locking in long-term interest obligations. As rates rise, debt servicing costs become a structural burden on budgets. Policy flexibility narrows, limiting room to respond to future shocks. Liquidity still exists, but no longer in excess. Markets increasingly distinguish between resilient and vulnerable debt. CDS reflects this repricing, even as Canada maintains high credit ratings. History shows that crises rarely begin in the weakest systems. They often emerge where confidence runs highest and debt grows faster than income and productivity. Prolonged complacency is often what makes reversal most painful. The banking system plays a crucial role in absorbing and transmitting debt risk. Canadian banks are well capitalized and tightly regulated, reinforcing their reputation for stability. Yet this same stability makes them the main channel through which monetary policy reaches households. Higher rates improve margins, but also increase credit risk. Long-term mortgages with periodic rate resets become pressure points. Interbank liquidity remains functional, but lending standards tighten. Credit flows to the real economy slow. Bank CDS does not signal crisis, but it reflects heightened vigilance over asset quality. Once again, real estate stands at the center. Prices need not collapse to change risk dynamics. Stagnation alone is enough. When assets stop rising, debt becomes visible, and the financial system must adjust to a narrower margin for error.